A little bit about myself before I start to talk about the investors' relations. Half of my brain is really creative, so I used to be a graphic designer. I built the first web design studio in Kampala 20 years ago when there was no internet actually. Then I built an internet portal in local languages like Swahili, Yoruba, and Kisi in Nairobi. That was one of the first successful projects actually, which was featured on CNN and BBC. The other part of my brain is a little bit analytical. That means I set up one of the biggest data center provider in Central and Eastern Europe in Prague. We have 3 different locations, and it was all about the data. So I decided to actually sell the company and build another startup which was funded from United States, which actually would predict of the future behavior of people. And I raised up to $7 million and wanted to sell the company to Google, which eventually didn't work out because Google made us as a showcase. So I became a Google Launchpad ambassador for the CIS region and Eastern European region, and that's one of the reasons of me being here as well. And eventually I got connected with some of the guys who sold their e-commerce businesses in Prague, and we set up Next Day Ventures, which is a post-seed, pre-Series A, 20 million euros fund focusing on this particular region. So I'm bridging, connecting these 2 worlds, East and the West. And today I would love to tell you a little bit of insights on how we look on this particular landscape and what is actually important for people like us to evaluate the companies. So the first thing first, you have to realize that there is no one particular investor type. There are different types for different stages of the company. So today I'll be focusing on angels and seed investors. And the rest of it, like Series A, Series B, are more for more mature companies doing, mergers and acquisitions, joint ventures, kind of transforming landscapes in various countries. I had the M&A advisory boutiques, which are actually very helpful in terms of introductions and doing the process of the deal flow. And one last thing I will be mentioning today is algorithmic VC. It's a new term that actually new VC funds are employing, data analysts to actually help them to evaluate the projects. So, for the angel investors, most of these guys are wealthy, experienced people, I would say. And I divided that into 7 different types. So the first one, the corporates, are usually people who do have B2B enterprise level experience, want to become a part of your company for certain equity. So these are like professional advisors. Okay, they usually bring in the business and the know-how and the contacts. Entrepreneurial angels are people like me who set up various businesses. They know how to run the company. They know how to how to build the product. They know how to build something from 0 to 1, as we say. Enthusiast angels, these are the guys, I would say, the most wealthy ones who just want to have a fun and basically wants to help to change the world. Okay, so if you find one of these, they're not gonna, I would say, help anyhow, but they just give you a little bit of money and maybe a little bit of credit as well. Professional angels, these are the guys you're gonna find maybe within accelerators, maybe this type of events. Usually they collect something what we call the syndicates, meaning that actually they are setting up the terms for the funding. They are collecting other angels or other angel networks and creating the syndicate, as I was saying, which means that actually there are multiple angels in that particular round. But the professional ones are doing it just for the money and the management fee, okay? Mentor angels, these are the guys who usually met in accelerators. They have specific domain know-how in the field you don't have. So for example, you are a bunch of 5 data mining specialists who are focusing on certain type of algorithms. You don't know anything about marketing, you don't know anything about finance, so you can get these guys on board, maybe as your advisors or mentors. They usually don't provide any money, and they don't usually take any equity. Head angels, similar to professional ones, basically these are the guys who lead the round. And dark angels, need to mention because it's actually happening quite a lot on the market. These are the guys, they do it on purpose to actually get to know your company from inside out and either to crash it down or just to sell it to the competition. By saying that, it's very good to actually realize that, I mean, it's very important for you to find out like why is actually those guys are investing in your company. You have to do your own due diligence on these people. Okay, not everybody who's got investor, money up in here on a LinkedIn or in a cash pocket does good for you. So this is actually happening pretty common to find out about the technology, find out about the strategy, the roadmap. They give you a little bit of money, but they got a lot of insights. That's one of my favorite pictures on how we look at how the product has been actually, or how the product should be built. Because in early stages, the final product should be the car, but most of the founders are mistaken themselves on actually how to get to the market with the product. So we like the third phase. So the company and the founders and the team is actually ready to build the car from scratch, but not wasting the time with actually building something what would not either scale or sell, and it will be used just for the learning purposes. Meaning, if I want to build a car, it's good to build a bicycle, but the bicycle is actually not solving the problem as the car does, okay? Seed investors. These are people who come in after angels. Angels are at the very beginning when the team is like starting to structure, and the seed money, I will show you the example how much money you actually can get from each of the group, are interested in these these three things. So one is the market. So how big is the market itself? How fast can you actually get there? And how much money you have to spend to get there? And what is the current traction? So what is something what we call the velocity, okay? So the change as of today comparing to yesterday. So how fast can you adapt to certain market conditions? And the seed investors' money are actually used to validate this, I would say, A/B testing or kind of a prototypization of the market strategies, go-to market strategies. You can have a look at the market different ways, similar ways. So we do come with something what is called a total available market. So how big is actually the particular, I would say, the problem you are facing, how much market share you can get in certain time until you run out of the investment or until you actually earn money your own way from the product. What is the general industry growth in that particular area? So if we talk about health, so what is the medtech? If we talk about the fintech industry, so what is the growth for the whole ecosystem? How big is the value? This can be calculated as of the sum of all the companies in there and the projections for their future sale. There are market analysis for that as well. And obviously international expansion. So it's good to have a testing market, smaller markets like we have back home in Czech Republic, which I forgot to mention. We are from Prague. And how ready the team is actually to go international. How much experience he has, how many professional, senior professionals he has. The team has to actually go to international markets. This is very nice example. I like it. I use it a lot just for you to realize that you are not alone. Okay. As from the investor perspective, our small fund, as I was saying, 20 million euros. We get maybe 10 deals a day. So 5 people only. So there are not many analysts you have to go through. So we don't know everything. Investors, they don't know everything, and you have to realize you are part of a much bigger story in here. So this is the landscape of something what is called the MarTech, marketing tech industry. The guy who was here, the French guy, who was here before, he falls into certain of these brackets. and it's actually a big mess, okay? So you have to know your strategy, how you differentiate in between here. What is the story in here? You want to be merged with somebody else? You want to become like a category leader? It's very important for you to understand where you actually fit, okay? Also, for us, usually bigger funds and even us, we are focusing on certain elements of this market because we don't understand, I don't know, the sales tools, so we'd rather go for the data, you know, or the deep tech tools. It's always good to understand the strategy for the VC. Metrics, very important. These are some of the most important ones in terms of the SaaS businesses and marketplaces, e-commerce businesses. So the first one is basically how sticky the product is. Google has one saying that actually the product should be somehow similar to the toothbrush, because the toothbrush you use twice a day and you don't even have to think about it, okay? So the churn is the number which actually says how many customers are leaving you on a regular basis, as low as possible. Net Promoter Score is something, if you ever use Airbnb, the last question on Airbnb is if you recommend the business to someone else, okay? If the product doesn't have 8 plus out of 10 Net Promoter Score, it's not gonna fly. Customer lifetime value, these are the money, I mean, this is the sum of the money customer gives you over that particular lifetime, meaning building up loyal customer base, okay? Higher, of course, better. Customer acquisition costs, very important. People don't realize that, but the sales funnel usually looks like this. So you have 10,000 customers here, maybe 10 paying customers. With the cost of acquisition costs, I mean, sales and marketing costs are very high in that sense. We prefer the sales funnel looks like this. So there are actually people coming into the funnel as you go down the funnel in that sense. So the cost of acquisition in a perfect example is actually minus. It's a negative number. Okay, so you don't have to spend any marketing and sales money because your product is fucking good. The people actually would pay for it right away and recommend it to someone else, so you don't have to use your own budgets. We don't believe in money spending for Facebook lookalike audiences, you know, Google AdWords, all of that bullshit, which actually makes just somebody else rich. Okay, if you have to spend money for marketing like this, your product is not good. Monthly and annual recurrent revenue. These are the money calculated on an ongoing basis. I think it's self-explanatory. Basically, higher, better. Revenue per customer, revenue per segment of the customer. It's always good to know who are your customers. So don't shoot for different types. Try to focus on certain segment and then multiply that segment, for example, in various different locations. EBITDA, somehow root word. Recently, everybody's talking about valuations. You know, we have all these unicorns. We believe EBITDA is important because EBITDA is a profit that actually gives you the leverage on how to build sustainable business, okay? Sometimes when you do market penetrations and you have to scale fast, obviously this is like kind of a postponed, but we do really believe that actually there should be customers paying for the product and you should have a premium price on it. If it's good, that gives you the profit. This is one of the practical examples on how the dashboard actually looks like when we are getting the reporting from the companies. For you just to have a look, because the benchmarking sometimes is hard when you're having like broader portfolios. And most of the VCs, they do benchmarking across certain industries. What does it mean to grow fast, actually? What the investor has in his head or her head at the back of the day, it's something what is called triple, double, double, triple. Usual VC funds, they last like 5-7 years like any relationships. Like in 7 years, all your blood cells will actually change in yourself, okay? When you were 25, you didn't have to solve the problems about having a family and kids. When you're having a family and kids, you don't have to solve the problems of looking for the job, for example. VCs, they tend to have this certain 5 to 7 years returning money at least 3 to 5 times, so 3-5x, meaning that if the fund is like 200 million, they have to return 1 billion at least. Meaning, out of 20 companies, at least one should have certain type of valuation and certain type of revenue. So the, the, it's overgeneralizing, but when the company has 100 mil in 5 years, it has to break down by this particular formula. So if you go back with me from 5 years, 150, 25, 7, 3, 1, 0, okay? So that's the speed we will compare you to other 10 companies in the world. Because right now the IT, the product, the distribution of digital assets is actually limitless. So if you're building a product here, we will compare you to what is the best in the market somewhere in, I don't know, Brazil or US. So the first year, 1 million, second year, 3, 5, you know, whatever, 20, 50, and 100 mil. This is a concrete example of on the gradient. So how much money you should raise and what is the performance you should have in those particular stages. Pre-seed, no team, no product, just few references that the problem exists. Seed, product market fit, there's early sign, actually customers are signing up, paying for the product. Seed plus sometimes is a bridge to get to certain exposure on the market. Series A is a growing product, you know, everything works, all this, you know, the company basically exists. The monthly revenue, that's on average what a company should have. Again, this is an example from marketplaces and SaaS businesses. Round size, these are based on valuations in Western Europe, so probably here it will be a little bit lower, but just the benchmark for you, how much money you can get if you reach certain level of the revenue. And these are the sources where you actually can find the funding for your product. Quantitative VC, very interesting. You know, we are our people, obviously, but we do use machines as well. Not many VCs do it, but as I show you the example of the complete landscape of the MarTech industry, there's a lot of companies and we don't bloody hell know what's going on actually. So we are using our own tools, you know, scrapers, data analytical tools for actually finding out the next whatever unicorn using public sources, internal sources. Most of the VCs will never tell you that they're actually doing it, but we do. And these are used for two primary reasons. So one is the sourcing. As I said, we got a lot of deals, but we don't know which are good or not. So we have to do some benchmarking. There are websites, Crunchbase, whatever, AngelList, where we can get that, what is the trending topics. And the other one is for screening, meaning that's the benchmarking within portfolios, okay? Because unfortunately, and it's changing, you know, the VC is a big balls club. They each compare their own performances, so there's a lot of benchmarking between portfolios, because the better story you have, the better unicorn you have, more funds you can raise next time for your fund number 2, 3, whatever. That's how, I don't know, Index, Assel, Andersen Horowitz, all these guys, they work in this way. Last one, I want to show you, each investor usually thinks in these terms about the exit. It's very hard to pick for a founder to actually realize that there is a start of the story and also there is an end of the story. Most people would love to change the world forever, you know, and kind of shift the power from somewhere else and build a sustainable, you know, unlimited business for the next generations. If you ever let enter a VC into your company, these are the things you have to think from the day one, okay? So the first one, you go public, maybe after 7 years you go to NASDAQ and you let another capital to actually pay you off. Or you're gonna be bought by, I don't know, enterprise level company. Microsoft can buy a team, you know, acqui-hire for the certain talent and technology. Third one, you go for the public offering. These are the Indiegogo sites and this kind of stuff. You can do syndicates just to allow certain type of investors in the company, and you can be paid off as angel. Or you can have a cash cow thingy from the company, meaning that you can step off as a founder and you can still have some dividends or bonds out of the company. And the last one is basically next round, meaning that you actually allow the venture capital and that will pay you off. That's how we earn money as angels and seed investors. Maybe last thing I want to mention is a little bit how we divided companies. If you look at the company as the cow, you either can milk the cow or you can kill the cow. Okay? For you as a founder, it's also important to realize what kind of cow you are actually building. So that way you're going to find the proper investor for your company. Again, pleasure to be here. I'm open to get you the feedback on whatever you guys are building here, on how this ecosystem works. And thank you for the attention.